Welcome to the online FX market analysis week ahead look for myself, Giles Cochran, Chief Market Analyst. Just as folks are coming in to the session, very warm welcome to you. Xandro, CN, good to have you. Danny, Ignatius, John, Kingsley, Philip, Salman, Vladimir, Yasser, Yao, good to have you all. Lovely. I'm looking forward to getting through this session. Got a lot to cover. We're going to be covering the fiscal response from the UK. I've got a few good things to share there. Hi, Philip. You can just, screen and voice all coming through okay. We're going to be looking at the pound, okay? We're going to be assessing what's going on with the pound. Just been getting some comments across to UK journalists here on the fiscal stimulus U-turn, and I'm just going to unpack what we can expect, what to look for, and we're going to get stuck straight into the topics we're looking at. So without further ado, let's not waste time. We've got a lot to cover, and I want us to get through where we're at. So I'm going to start with the big picture. So today, we're focused on that UK statement, and we've been seeing the pound moving higher. Now, overnight, what we saw is some negative sentiment in markets, which turned at the European Open. I was covering some live analysis, and the sort of turn happened early in the European session. So Asia Pac was negative on the China Communist Party news that China's sticking to that COVID zero plan. That's more negative for sentiment because they, a few cases and you lock down whole cities. That's negative for economic activity in China. So China's Communist Party conference is saying, no, we're sticking with that plan. And there's also the tensions that are expected to ongo between China and Taiwan. China want to bring Taiwan back into China control, similar to kind of a Hong Kong situation. Taiwan's resisting that and seeks independence. That's a big spark, a big source of tension out there in the South China Sea. So that was more negative sentiment. Now we start the session more positive. We can see US equity futures pushing higher, DAX, Euro stocks, China 50, UK 100 pushing high. Now, some of this has been from the bond market, I am absolutely convinced. Now, we can't not cover this. If you look, this is UK gilt market here. So you see all these bond markets. So you see how the UK gilt market is, the yields are moving lower. So some good bids have come into UK government bonds. And a number of buyers said, yes, we are reassured by Jeremy Hunt, the new UK Chancellor's fiscal plan. And he's basically announced a complete reversal, essentially, of what the previous Chancellor, Kwasi Kwarteng, had announced. Now, remember, there was that mini budget, and you can see here in the bond market, do you see this big surge in UK 10-year yields? That was after that strange mini budget that was cooked up between UK PM Truss and Kwasi Kwarteng, and it was basically pumping billions into the UK economy as the UK struggling with inflation, which is the worst possible thing you can do. And so bond traders saw this and thought, well, gosh, interest rates are going to have to surge to cope with all this. And there was disorder in the bond market. It was panic. And banking had to step in. This is reassuring, okay? This big bid into UK gilts is just saying it's under control. So early signs are very good. I was buying the pound early this morning. I have taken profit in all my positions because it was short-term trade, but it was just on that reassurance. Yes, the pound was happy with that, and as long as that remains tracking lower, that should be broadly supportive for the pound. Now we're not out of the woods. We've got UK Chancellor Jeremy Hunt speaking to politicians, I think 3 o'clock later on in the UK, so that's something to look out for. But here in the UK, earlier media reports, financial watchers, political spectators, good signs. But the bond market is the key. Now, there's a little saying in the market which says the bond market is the truth. Remember this. If ever you see a divergence between equities and bonds, look at bonds. They tend to be the truth. If you see a divergence between currencies and bonds, look at bonds. The bond market tends to tell you the truth, and that's because the bond traders, they're longer term traders. They're trading out for 12 months, 1 year, 2 years sometimes. And so those longer term traders tend to have a more settled view, and that tends to be a fairer reflection of medium term narratives. So that spilt over to other bond markets as well. And so you remember the Fed, When they saw what happened in the UK, they suddenly got a bit spooked. They thought, my goodness, if that can happen in the UK, you know, if we misstep on our policy, we could do the same, but it'll be much worse from the US. Remember, it's a US-centric world financially. The US is the largest economy. It's the biggest player. The Federal Reserve is the biggest central bank. It's got the most firepower. What the Fed does, you know, and the rest of the world follows. So if the Fed eats, you know, sour grapes, the rest of the world's teeth is set on edge, if you follow the analogy. And that's reassuring for the pound, but also for wider sentiment. So we've got risk-on sentiment today, and you can see a bit of support there in the S&P 500 futures markets. That's broadly supportive. Wouldn't be surprised to see that push higher. Any dips lower in that can be considered suitable for buying. This was the pound US dollar, which I was looking at earlier in the session. Just saw that positive move higher, and I was looking at buying that support area, and then I took profit up at that R1 resistance area earlier in the session on the announcement. And then I'm looking to buy potentially if any dips back here today is suitable for buying. Stops just the other side of that S1 pivot point. Absolutely fine for today's sentiment. Just have to watch out any weird dollar strength that doesn't come and disrupt things. So dollar weakening, that's lifting currency pairs. Other thing to look at, dollar yen. Remember the dollar yen, the reason the dollar yen is moving higher, right, is because of, excuse me, is because of interest rate differentials between the US and Japan. So you see these 10-year yields, as long as they keep pushing higher, then the dollar yen will keep pushing higher as well. For the dollar yen to move lower, we really need to see 10-year yields pushing lower. So until they do, this will keep moving high. Now we know, don't we? The Bank of Japan said they don't like this very weak yen. We've covered this a number of times on these webinars. That's when they intervened at the end of September to that big 400-point candle. If they intervene again, so first of all, they're unlikely to intervene, right? Because they know that they're fighting something inevitable. That the dollar yen will keep moving high as long as yields move high. They know they're not foolish, but they want to freak participants out so that they always think there's a potential that they'll intervene, which is understandable. They want to try to do the best they can. Now, if we saw like sudden intervention, you know, one way to potentially trade it would be on a break of that trend line, looking at taking profit about 145. Now you see here, you see the dip was bought. If the Bank of Japan intervened, you expect the dip to be bought, just like it was here at the end of September. The best chance for dollar yen downside will be if 10-year yields move lower or the dollar weakens. Until that happens, dollar yen should keep tracking higher. So key things to look at 150. That's a key area to be on your radar. A lot of analysts have spoken about this 150 region. It is a key kind of overhead resistance area, and look for a potential break of that trend line. And if you use a squawk service, you know, any intervention from the Bank of Japan, you can look for a sudden scalp lower, but then remember here, take profit. And if you look back to the end of September, see the way that the market reacted, right? So in the space of what, you know, 1, 2, 3, 4 hours, we found the low, okay? And then the dip was bought. So it's very fast. That move was lightning. So that's why it's best to have a sell and stop order. But remember, you might get some slippage. Manage your risk, define your risk carefully. Slippage is just normal. You just get that when you have a very fast moving market like this. So it's not necessarily anyone trying to cheat you, but you have to be aware of that. You get slippage and you'd expect that dip to be bought. So that's worth saying with dollar yen. Pound US dollar, we've got an upside bias today. Dollar is weakened in the session on that positive risk sentiment. And, you know, that's where we're at today, right? Now, I want to get into the detail of what's coming. And you can just see in terms of currency strength for today, pound's the strongest currency alongside the Aussie and New Zealand dollar, which you'd expect. Risk on, New Zealand Aussie CAD up high, pound up high because of the UK gilt market, liking Jeremy Hunt's fiscal stimulus U-turn. We've got the yen, the dollar, weaker the session, Swiss franc also a bit weaker. All of that is positive for risk. So we're looking at a risk on footing as we head into the US session. Now, let's look what we've got coming. So light on the calendar this afternoon. We've got ECB speakers. If you're struggling to trade the euro at the moment, you're not alone. It's very difficult. Think of all the drivers the euro has. There's a coming euro recession to the downside. There's the Nord Stream gas pipeline leaks. There's also the prospect of the Russian-Ukraine crisis, on one hand, getting worse because of the increase in activity from Russia to Ukraine, but then there's also Ukraine managing to repel Russian aggression. So it could go either way. We've also got the risk of fragmentation in Europe, and the looming inflation issue is impacting German economic sentiment. So there's so many drivers of the euro. I'm not trading the euro at the moment because you could see something that could be good, something that could be bad. There's a mixed number of drivers. Got some ECB speakers, but the outlook is that they're going to have to be hiking interest rates to contain inflation, just like much of the rest of the world. There isn't much of a surprise. The event that I do see is tradable, depending on your time zone, is New Zealand inflation data. Now, the RBNZ are the most hawkish central bank of the major central banks, and Governor Orr doubled down on that hawkishness at the last meeting. Now, the New Zealand dollar can be a real pain. Let me just show you here. If you look at the index and you look at the New Zealand dollar, you would be surprised, when I told you that the RBNZ is the most hawkish central bank of the major currencies. And look how much it's been falling over those last days. The New Zealand dollar can do this, and we saw it similarly at the end of November. The RBNZ around here in November 2021 turned very hawkish, and then we had the New Zealand dollar sink, for hundreds and hundreds of points. So watch out. I don't want to trade the New Zealand dollar on a swing trading basis. Personally, I want to trade it if we get a little divergence. So the Aussie New Zealand dollar is the go-to currency pair for trading, but here's what I'm looking for. The best opportunity will come from a big miss in the data. If we get a big miss in the data, it will mean the RBNZ will need to be less aggressive in hiking interest rates and should be New Zealand dollar downside. So if we have the year-on-year coming in sub 6.3, if we had the quarter-on-quarter coming in below 1.2, I would look at scalping Aussie New Zealand dollar upside. Okay, miss below 6.3, miss below 1.2, I'd look at scalping Aussie New Zealand dollar upside, number one. Number two, if we get a beat in the data, I think that could still see some New Zealand dollar strength, and the New Zealand dollar strength is a bit overdue. So I would probably trade Aussie New Zealand dollar downside. Or if there is a beat and we've still got that risk on sentiment that we've got today, I trade New Zealand dollar US dollar upside. So on a beat above 6.9%, quarter on quarter above 1.8%, both of those, I go long New Zealand US dollar. But remember the way the New Zealand dollar reacts. It reacts funny, so just take a scalp, just a few 30 40 points into an overhead resistance area and then walk away. That's my approach that I'm taking, but I do think that's tradable. With trading the Aussie dollar, we've also got these RBA stuff. We've got RBA meeting minutes and RBA bullet. Remember, the RBA's turned a little bit more dovish. They only hiked by 25 basis points at the last rate meeting, and short-term interest rate markets are seeing they're going to be less aggressive. So I expect less aggressive outlook. If that's more dovish and that's hawkish, we could see more Aussie New Zealand dollar downside. So look at that. That could be not a swing trade, but that could be a trade for the next sort of 3 to 6 hours. So if that's hawkish, that's dovish, Aussie New Zealand dollar downside, next 6 hours, manage your risk. Don't see any problem with that. The Chinese data is also coming out, GDP growth. Now, I think I saw a headline that this data might be delayed. So that data might be delayed, but remember that will impact sentiment. If China is shrinking more than the market's expecting, expect risk off markets. If China is growing faster than the market is expecting, expect risk on markets. So if we get the GDP growth coming in above 4.5 for the year on year and above 4.3 for the quarter on quarter, expect that to either accelerate risk on markets. German's U-Gates are not worth trading. Look how low it's expected to be. Who cares about this? Yeah, the outlook is bad for Europe. Everyone knows that. If it comes in worse than expected, is that going to surprise people? No. If it comes in slightly better than expected, is that going to surprise people? No. It's just grim. And traders have been expecting that for weeks and weeks now. So nothing tradable on the Germans' view. Can be a good opportunity in some occasions, not this time. ECB Schnabel, but again, US industrial production more interesting. What I'm looking for here is opportunities to go short the dollar. So dollar yen downside, gold, silver upside, S&P 500 upside would be my preferred method. And what I want to see is I want to see industrial production year on year coming in below 3.3% and a month on month coming in below minus 0.4%. If I get that, I like S&P 500 longs, gold, silver longs, and then pound US dollar longs. Wednesday, UK inflation rate. Again, the lower this is, that would probably be more relief for the pound. So if I saw this coming in lower than the market's expecting, year on year below 6, month on month below 0.2%, then I'll expect that to potentially boost the pound. So just watch out for that reaction. We may see a counterintuitive reaction. If you're ever uncertain, just look at the bond market. UK gilt market helps with the expectations there. The Canadian inflation data, important. The best opportunity here is going to come from a miss. Bank of Canada have been very hawkish. And if you look at the Canadian dollar, unlike the New Zealand dollar, it's just been rising and rising and rising. So there we go. You see the CAD? It's been rising and rising and rising. What? On hawkish Canadian monetary policy, they surprised markets with a surprise 100 basis point rate hike at their last decision. The best opportunity will come from a miss in the inflation data. If inflation is really low, then I'd look at trading either dollar CAD upside or pound CAD upside. What you want to see is this: year on year below 6.5, month on month below minus 0.3, and the year on year 5.7% or lower. That would be supportive for pound CAD upside, most likely, depending on what happens later in the UK gilt market, but early signs are good, or dollar CAD upside. The trim mean is the one you want to look at as well. That's, important. If that comes in low, below 5%, 4.5 or 4.9%, in line with those other metrics, great. Canadian dollar weakness would be good. Thursday, Aussie jobs data. Okay, Aussie jobs market has been really firm. I'm not really expecting much here, but you always can do because the Australian jobs market is important. A big miss in this data would be Aussie New Zealand dollar downside. So that's what I'd look at, depending on what happens with the inflation print. But if the inflation print is high, then I look at a miss here, I look at Aussie New Zealand dollar downside. And if we see dollar strength, I'd look at Aussie US dollar downside, but that will depend on the risk tone. So what we want to see for the best opportunity will come from shorting this on a miss. Participation rate, you want to see it below 66.6. Full-time employment, we want to see that fall. Unemployment rate rise above 3.6% or higher. Employment change, we want to see that below 13.5 thousand. But I want to see a decent miss to have like kind of a trade on that. If it's just like only just missing them, then you might scalp a few points, but honestly, I wouldn't bother. The initial jobless claims shouldn't be too much of a mover. Number of Fed speakers. Watch the Fed speakers. What we're looking for from Fed speakers is Fed speakers who are turning from hawkishness to dovishness. That would be the best opportunity if we see any signs of pausing from Fed. And then on Friday, we've got Japanese inflation. Look, see how low it is compared to the rest of the world. Still, 3.1%. The only thing to watch here is, say the inflation comes in much higher than expected, then there'll be speculation that the Bank of Japan will have to hike interest rates. So that would likely strengthen the yen. So if that comes in really high, 4% or something, then just look for a short, sharp thrust down in dollar yen. Got retail sales, a big miss there could weigh on the pound, but I have to depend what goes on with the inflation print, and there's a lot to get there. There's nothing to flag up at this stage, but keep your eye on it nearer to the event. Fed Williams speaking on the Friday, and that takes us to the end of this week. So there's a lot going on. I've got a few minutes left. I want to cover the big picture. Very important when you're trading to keep the big picture in mind. And pound US dollar pushing up into that overhead resistance. Very nice. Oh yeah, and we're seeing a bit of dollar weakness as US traders are going to be stepping in. That's very nice. Pound US dollar pushing up, S&P 500 potentially pushing up from there. Let's just have a little look at the so Any retracements back down to that 360, 360, 3600 region is suitable for going long at the moment. So just keep that on your mind for S&P 500 longs. Quick look at the big picture. Big picture is that we had that CPI print hot on Thursday. Do you remember when it came in? Market expect, and then there was this weird reaction, a kind of sell the fact reaction, almost like investors said, yeah, we've been buying the dollar, selling stocks, selling gold, selling silver. We got the hot CPI, yes, so what? And so market rallied higher. One of the biggest turnarounds in the last couple of years in the S&P 500 on that day. See, big bullish engulfing bar. That's hawkish. Now, then we had that hot University of Michigan's consumer sentiment print on Friday showing that inflation is high. So then markets sort of thought again, oh, well, perhaps the Fed will have to be even more aggressive. But now the positive risk sentiment is just helping equities move higher. But what I'm trying to say is we're in a very tricky market. No one really knows how things are going to develop from here. And it will be the incoming data that will be key. And the data to look at is US growth, US inflation, and one you might miss, which is earnings. Earnings can impact the wider risk tone. Netflix and Tesla Tuesday and Wednesday, if we get a big miss in those prints, or they start to really get worried about the US consumer, that can spill over to wider market sentiment. So watch earnings. Apple is the one to watch. A lot of analysts are flagging that as a big bellwether. If things are bad at Amazon, things are bad at Apple, that can be a good indication that consumers are struggling and that growth is about to rapidly slow down. So just watch as Tuesday, as these earnings, don't ignore them. If there's a big miss in these earnings, look for sentiment to change elsewhere. Folks, we've done a lot. Don't forget, you can get this on recording. I've tried to download as much information as I can to be as helpful as I possibly can to you. I am coming to Dubai for the Forex Expo on Thursday this week. Really looking forward to it. Please do pop by and say hello if you're around. I love to meet people, especially people who I've met before on these webinars. You have to tell me you come to the webinar because sometimes I don't see your faces, and I love it when I meet someone who goes to the webinar. It's always a real treat. And particularly that some of you guys who've been listening to me for ages, really appreciate the support. What's the other thing I'd say? I think, yeah, so that means the Wednesday report, the Wednesday webinar I won't be doing, so I'm going to be out and about, and it's too hard to kind of run that webinar. I haven't got my screens, and it's not my normal setup here at my home office. So Wednesday won't be here, but I am scheduled to be back on Monday the week after. S&P 500 best opportunity tomorrow on US manufacturing industrial production data. Yeah, I'm Massey. Let's have a look at that. So yeah, that's fine. So what we're looking for on the industrial production, we want to see a miss. So if we see industrial production US, if we see that coming in a big miss, okay, below minus 0.3, and we see the year on year below 3.3, something like that, then I would look at selling the dollar. So I'd either look at pound US dollar upside, Massey, that's a good opportunity if the bond market is going to go by. S&P 500 longs, yeah, I agree. Gold, silver longs, dollar yen short. That's what I see. The only problem with dollar yen, just watch out for Bank of Japan shenanigans, and people can be a bit funny with it. Nice, Massey, very good. Yeah, Yasser, definitely we'll see the excellent Yasser, good man. Yeah, good, excellent. Look forward to it, folks. Right, we've covered it all. Well done. And yeah, you're welcome. You're welcome, Massey. And look forward to coming back and being here on the following week, Monday. This is an exciting time to be trading. There's a lot of potential opportunities, a lot of potential deviations, a lot of opportunities that we have ahead. So look forward to taking us through. Take care, everyone, now, and look after yourselves. Thanks, everyone. Goodbye.